Good. Okay. So this session is part two of last week's session, introduction to the Forex market. And this session aims to go into detail um, to explain some of the concepts that are, above the surface level. Some concepts like pips, lot size, um, leverage. These concepts are very, very crucial to your development as a trader. So if you don't understand them, then you might as well not trade or quit. No, don't quit. But as long as you keep going, you will learn. But these are things that are very, very crucial to your understanding as a trader. I hope you can hear me. Can you hear me? 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 Tracy, can you hear me? Okay, no problem. Let's move. Okay, so the contents are eight. The first one is building your bias. So I'm just going to briefly brush through them. Building your bias is going to hint at you coming by an analysis, coming by a bias in the market. There's only three biases you can find in the market. Number one is uptrend, number two is downtrend, number three is consolidation. So you're either building a bias around a bullish move or a buy scenario, a bearish move or a sell scenario, or a consolidation market where the market is just ranging, is trading in a confined space. You understand? And in those market conditions, you don't do anything, you just observe the market. And people who have traded for a long time see those market conditions and they know how to enter. But I'm saying you don't have to do anything because you are quite new to it. You may be surprised your what the forex market will do to you should you participate in these kind of events. Trading in lots exposes the bright side of trading, where lot sizes allows you to take huge risks, and then it's a double-edged sword. So you take huge risk, and when you're incurring loss, you incur it big. Why? Because the lot size has what it has increased your it has increased your risk capital. Not your risk capital, but it has increased your trading power in the market. So an account of $100 can trade thousand $1,000 contract. Why? Because of leverage. Sorry, because of lots and also leverage. Pips is the measurement. Leverage is the power given to you by your broker. The spread is the cost. Forex orders are the type of orders you place in the market to take you in and out of a trade at any time you have set for it to. Then demo preparation. From here, we'll set up a demo account where you would build an account from a small amount to whatever amount you desire. You understand? Then the last one is the riches of Forex. Now let's get into it. Know when to buy or sell. Building a bias. Now, before you buy or sell any market, you first have to analyze it. You first have to go through the rigorous task of taking data from years ago, building it on fundamental analysis, building it on technical analysis, and also sentimental analysis. This is one of the analysis that is less spoken about because people don't really gear towards that side. Sentimental analysis is looking at the overall mood of the market. So you just enter a market and you see that, oh, the long-term bias for this market is a buy, it's a bullish trend. Then what you can do is you can also wait or you can enter immediately because you know that if it's in a bullish direction, it's likely going to continue for a period of time, not forever, but for a period of time. You understand? So building a bias, knowing when to buy or sell, you must first analyze it and come to a bias. So the highlight here is analyze. Analyze says that you have to go through. Oh, I see. I assume this was happening. Hold on a minute, please. Trying to get the screen back on. Okay. Okay. So this was the contents. This was the contents. This was where I was reading from. Let's go straight into it. So yeah, before you buy or sell any market, you must analyze it. The key word here is analyze. And analyze comes in three parts. First, technical analysis. That's the part I excel in, and that's the part we'll be learning. Second, fundamental analysis. And then third, sentimental analysis. Technical analysis requires you to take a lot of data. You watch price from sometimes the beginning point, depending on the type of trading you are doing. You may be doing position trading, swing trading, um, intraday trading, day trading, and scalping. Do you understand? So you are analyzing based off of the type of trader you are. Do you understand? So if you are a scalper, you probably be looking at the lower time frames, the 1 hour, 30 minutes, 15 minutes, 5 minutes, 1 minute. Do you understand? Exactly. So when you're analyzing, you need a lot of data, sometimes 6 months ago data, sometimes 3 months ago data, sometimes a whole year's data. And then you analyze. That's if you're analyzing based on technical analysis. Number two, fundamental analysis. You look at the macroeconomic news, you look at the geopolitical events, you look at the political events, you look at developments occurring in the market, and you use these news or these things or this information that you've gathered, you use it to aid your analysis, and then put in a buy or a sell order based on the conclusion that you've come about. Do you understand? So you may be looking at a market, let's say the US dollar market or the euro market or the GBP market. You understand? Now, if you look at the United States now, if you look at the United States now, they recently had or they recently hosted the World Cup. Wow. So the World Cup is an event that attracts a lot of people. You should put that in mind. And then when people are coming to the country to watch the games, they are coming with money. They are coming with their country's currency. They are coming to change it into the dollar. So the value of the dollar is increasing. Also, they're coming to spend it. They're coming to, buy tickets. They're coming to buy drinks, buy snacks. Some of them to come there, invest in the country. Some to buy stocks, some to buy lands. They just participate in whatever is going on in the market. So if you're a fundamental trader, if you look at something like the recent event, if you look at how do you call it, the football that got hosted in US, right? You know that this particular event is going to increase the economy of the US market, Yubab. And then if it's increasing the economy of the US market, should you buy the dollar? That means you are going to profit. Why? Because you've analyzed it right. You've seen that if the US market is having all these activities going on, then that means their economy is going to increase, and then it's going to increase the, how do you say, the strength of the dollar or the value of the dollar. Do you understand? So if you buy the dollar, what do? You gain profits. Do you see? So I'm just introducing you to the types of analysis, how to build a bias. Do you understand? So if I'm building a bias, let's say the week approaching, right? I want to build a bias for the week. I'll first look at the economic events surrounding that particular pair. So let's say I'm trading the GBP USD. So I'll go to my trading news plug. Yes, my trading news plug. That means trading economics or Forex factory. Then when I go there, I would what I'll do is that I would watch I would watch the news events that are going to occur the coming week because they list it on those platforms. Do you understand? The coming week, I'll watch the news events that are going to be listed on the coming week. Then when I watch those news events and I see that there are news going to affect the GBP or the dollar, then I'll start building my analysis around that. Do you understand? Start building my analysis. So I'll say, okay, um, sometimes you watch the events happening in the world. So let's imagine we are living in a few weeks ago before the World Cup started, right? I'll say, okay, they're going to host the World Cup in Canada, in Mexico, and in US, majorly US. So I'll say, okay, cool. How am I going to do my analysis? So knowing this, that's number one. Then I'll go to my chart. I'll look at what the US dollar has done previously, what it's about to do, and then I'll use those two things to build my analysis. So these two things now, I've seen the events that are coming to happen in the US. I've built a bias around it. Then I'll go into my charts. I'll take the data. I'll look at, okay, these are the major price points that the US dollar reached before it showed a certain type of reaction. Then I'll put that one too into consideration. So these are the things you would need when you are building a bias. Shey Bob. Now, you now take your trading app or your trading, you take your phone, you enter the trading terminal, and then you place a buy or sell based off of the analysis or the bias that you've come to. You understand? The easiest starting point is fundamental analysis, which means basing your trades on economic conditions of the base country's currency. The easiest starting point is fundamental analysis. I mentioned this here because fundamental analysis kind of it has an easy tune to it. If you understand what the market is trying to do, then you'll be able to you know trade the fundamental news. You understand? So let's say you are looking at um the US dollar again, the US dollar, or let me use the Ghanaian cedis, right? You're looking at the Ghanaian cedis, and then you are building a bias around it. That means if the government announces that they are going to do a project, maybe connecting the road from an underdeveloped region to the capital of the country, then you know that that's going to increase what import and ex no, that's going to increase the, or what's the word for it? The transfer of goods. Do you understand? That's going to increase. So if there's a producer in Accra or there's a producer in, let's say, Volta region, maybe they are producing, what do they even produce in Volta region? Let's say they are producing corn. You understand? But this corn that they are producing is a market for only the people in the Volta region. Do you understand? So they produce it, they send it to, let's say, Aflao, Keta, Ho, all these places. But should the government announce that they are coming to connect a road from Accra to Volta region, then you know that okay, it's going to boost production. More people are going to what to demand corn because yes, there may be production of corn going on in Accra, but they are going to demand more because if there's more supply, if there's more supply, then the price can what? The price can come down. so that people too can buy more. Do you understand? So yes, these are some of the things you do when you are trading fundamentals. That's why I was saying that the easiest starting point is fundamental analysis. Not to say that fundamental analysis is easy, because when you are trading something like FOMC or CPI or NFP, those news or those fundamental events, they don't have mercy on your account. Do you understand? You can put your order inside, no shame. The market will drink everything. Do you understand? So I wrote here is easy because you are able to build a quick bias around it. Do you understand? It's either doing one thing, is buying or is selling. You get it? Whereas technicals, you would have to observe the markets, look at the price data from a long time up until the current time, and then use to forecast where price is likely going to go. You understand? Good. So examples. If US economy is strong, then the US dollar is likely to appreciate. You buy US dollar base pairs. Do you understand? So if the US economy is strong, like it has shown some signs of strength the past few weeks and then currently, you understand? So it's likely going towards appreciating value. Do you understand? So you buy US base pairs like USD CAD, USD GBP, USD JPY, the pairs that have USD as the base. Do you understand? The pairs that have USD as a base. So a pair like XAU USD, you will not buy that pair because XAU is the base. Do you understand? Exactly. Now, if Eurozone shows some weakness, then Euro is likely to depreciate. So you sell Euro base pairs like Euro USD, Euro GBP, Euro JPY. Do you understand? So fundamental is like you are making analysis or you are making forecasts based on the market's, events or the country's economy. You get it? So for a country like Iran, you know that since the war started, they are not going to produce oil. Do you understand? Or a country like Iran, since the war started, right? They're going to block the Strait of Hormuz. That means what? Oil is not going to be flowing as it used to. Do you understand? That means the price of oil is going to go what? It's going to go high. But now we are dealing with currency pairs. So the Iranian currency, I don't know what they call it. The Iranian currency will depreciate in value. Why? Because countries are not bringing their ships to the Strait of Hormuz. On top of that, they are bombing the Iran countries. That means production is coming to a halt. And then investors too don't like things like this. If they see things like this happening, they flee the country. They stop their business, they close it down. So either they sell it fast, they close it down, go and then come back when the war is done, or they just stop every investment that they are doing. Do you understand? And then if people are fleeing from your country and then they are not investing, then your country is going down and is going to go down very, very fast because people are the core of every economy. So you look at the University of Ghana like this. The reason why the people who sell in the night market have, a lot of patronization is because there are numerous people on campus. Somebody will eat from somewhere. It doesn't matter what you are selling. You see some Kosiani Meku seller, she's still getting customers because there are many, many people in the country and they are coming from diverse economies or diverse communities, diverse places. Do you understand? And then when they come with their preferred meals or their preferred whatever they prefer. Do you understand? So a group of people will come and then they say, oh, as for me, I like shawarma, I like burger, I like loaded fries. Another group of people will come and say, I like banku, fufu, kenke, omutuo, tuwo zafi. Do you understand? So the core of every economy is people. So if people are fleeing Iran, if people are fleeing Israel, Russia, Ukraine, all these places that wars are happening, then their economy is going to drop. And then you, as a fundamental trader, if you see something like this, you can quickly make your analysis and then sell or buy the currency. Do you understand? So fundamental traders always have a macroeconomic perspective on the market. This is very important because they don't just look at, Auntie Mary's kiosk. Maybe Auntie Mary made a sales of 1,000 CDs today or 1,000 CDs last month. They do not care about just Auntie Mary. Do you understand? They want the whole economy. That's why I began mentioning things like war, things like oil, mass production. You understand? They don't look at one. So if a fundamental trader is going to make an analysis, he will not just look at the town or the village called I don't even know some villages to use, you understand? But maybe you not just look at the village called you not just look at the village called Kumasi. You not just look at the village called um Koforidua. I'm just mentioning, I'm not saying these places are villages. I'm just, giving an example. He will look at the whole, he might even look at the whole region or all the 16 regions. You understand? He will look at all the 16 regions and say, okay, based off of what is going on in all these regions. So let's assume the government decides to do, during the former president, Nana Addo Dankwa Akufo-Addo, he said he's going to do, during his tenure, he said he's going to do one district, one factory. Do you understand? Things like this excite investors. So sometimes the government has not done it all, but sometimes before the government attempts to do it, investors are going to come into the country and do what? They are going to start putting their money in places where when the government finally implements these systems, it's going to what? It's going to benefit them. Do you understand? Let me give you a hint. During the current president's tenure, right? That's President John Dramani Mahama. He says he's going to implement the 24-hour economy. Now, what this 24-hour economy is going to do is that during the evenings, the Ghanaian economy experiences low volumes. Do you understand? But now that this thing is going to be implemented, what it's going to do is that it's going to boost the Ghanaian economy, even though it's in the evening and majority of the people in the country are sleeping. Most of our economic, transactions happen during the morning when the banks are active, when people are going to work, when the street is active, the churches are moving up and down. You understand? But if he says he's going to do a 24-hour economy, that means even in the evening, people will be working. And if people are working, that means it's going to contribute to the GDP. The GDP is the gross domestic product of the country. It's going to increase the whole economy of the country. So fundamental traders are looking at the macroeconomic perspective, not the microeconomic perspective. The microeconomic perspective just looks at individuals and then markets. Do you understand? The macro looks at the nation. So things like geopolitical events, economic events, political events, when they are going to elect. So when they were going to elect President Trump, right? When President, let me go to the let me make this thing view my whole screen. Hold on, it's going to shut for a minute. Display capture. Good. So now even if I open another application, it's going to show here. I'm going to put. I'm going to take the chart back to what happened in the markets when President Donald Trump was elected. Okay, so 2024, right? 2024. let's go to, wow, I just saw something happening in the gold market. Let's go to Bitcoin in 2024. Let's look at what happened in Bitcoin. This is boom. What's a specific month? I heard is, you know, I heard is November or so. So look at what happened during the November. Look at the Bitcoin economy. Can you see how it sprang up? Like it just started shooting upwards. Do you know why? It's because they elected the president Donald Trump, and everybody knows that Donald Trump has holdings in the Bitcoin market. Do you understand? So people are looking at it. That's why I was saying that fundamental traders look at macroeconomic perspective. So they will not just say they are looking, they are trying to find out what is happening in maybe New York or Ohio State, or you know, I don't know some US cities, but I'm just going to stick to the two. They're not just going to say they want to know what's happening in Ohio State or New York or um Atlanta. You understand? They are going to look at what's happening in the whole US economy. You get it? So when Donald Trump got elected, people know that okay, since Donald Trump has been elected, what is he going to do? He's going to put more investment, or he's going to, I don't know exactly what he is going to do, but people know that okay, since he has become the president, it's going to be more sure, or it's going to be more accurate. Bitcoin, you understand? Bitcoin is going to be more accurate, or it's going to be more, there's a word I'm looking for. You can bank on it. Do you understand? You can look at Bitcoin and bank on it because someone like the president of the United States has holdings in the Bitcoin market. Do you understand? So people are going to do what people will sell their houses, sell their cars, liquidate it, turn into money, and then start investing in the Bitcoin market. Look what happened during that time. Bitcoin move. The Oh my God, it's like over here showing 3 million. I don't know how to convert the Bitcoin pips, but it's like, if this is what I'm seeing here is accurate, then that's 3 million pips. 3 million pips is not joke. This can turn you into a billionaire overnight, provided you have the right capital. Do you understand? So uh that is what fundamental traders look out for. Do you understand? Good. Let's move on to the next. Trading in lots. The bigger the lot, the bigger the profit and the loss. The bigger the lot, the bigger the profit and then the loss. Again, the bigger the lot, the bigger the profit and the loss. You understand? So hold on a minute. I have to change the settings. Okay. Okay. We are good to go. Currencies and assets usually come in lots. You understand? Currencies and assets, they usually come in lots. What that means is that when you go to Forex Bureau, and then you take $1 there, they'll throw you out of the Forex Bureau, because changing a $1 bill is not going to give them commission, it's not going to give them any profit. Do you understand? So what they do is that they bundle it. They start, they set a standard. They start from, it could be 50, it could be 100, it could be 150, it could be 200. Do you understand? And in trading, they have lot types. and then they've named it a nano lot, a micro lot, a mini lot, and then a standard lot. The standard lot is the highest lot you can trade with. Do you understand? So now, if trading comes in lots, that means you are going to have to have a certain amount of money before you can trade the market. Do you understand? So for people who invest small, like if some people can invest $5, $6, Charlie, yeah, just I don't know if you really want to participate in the forex market, but $5 and $6 with some way, wow. You understand? Yeah, but if that's what you have, then boom, you can go with it. Do you understand? But it's likely not going to, it's likely, I'm not saying it's not impossible, I'm just saying it's likely not going to yield that return that you are looking for. Do you understand? So currencies and assets usually come in lots. Instead of trading £1 or $1, the forex trades in bundles called lots to make profits meaningful. You see over here, we wrote only profits. We didn't add loss. But think about it. If you are increasing the lot you are trading with, that means you are likely going to make a lot of profit or you are going to incur a lot of loss. Do you understand? Now, let's break the lot type down. Nano lot is the lowest, and then the unit of currency is 100. You understand? So if you say you are buying 5 nano lots, what you mean is that you are buying $500 of the US market. You understand? You see, 5 nano lots. You are buying $500 of something. It could be the gold market. It could be the GBP USD CFD. It could be anything. You understand? But 5 nano lots trades in bits of hundreds. Do you understand? It trades in bits of hundreds. So $100, $100, $100, $100, $100. Five. That's 5 nano lots. You understand? And then the pip per value. Pip is the measurement in price. So if price moves from 1.005 to 1.006, that's like 1 pip. Do you understand? Not accurate. We'll get to pips. I'll explain it better. That's 1 pip. So if you place a trade with 5 nano lots and it moves 1 pip, that's $0.01. That's less than a cent. 0.05 because it's 5 nano lots. That's less than a cent. So if it moves 2 pip, then you get 1 cent. If it moves 20 pips, then you get $1. Do you see how slow it is? Do you understand? Meanwhile, if you have 20 pips on a standard lot, that's 20 times 100. Let me do the calculation here for you. That's like 200. It's not like I don't know, please. Yes. So if you are trading on a standard lot and then you place 20 pips trade, and then you are using a standard lot, so you are using a standard lot for a fixed a pair like GBP USD, and then you go 20 pips, you've made $200. Do you understand? And that's big money. And if you lose 20 pips too, you've lost $200. You understand? So micro lots means you are trading in bits in units of thousands. So $1,000, $2,000, $3,000, $4,000, $5,000. You understand? Good. Per pip, if you place a trade on a micro lot, any pip movement is 1 cent. Yeah, is it 1 cent or 10 cents? Let me see. Let me check, please. That's why we have Google nowadays. Knowledge is on your fingertips. Okay, so this is 10 cents and this is 1 cent over here. This one is 1 cent. This is 10 cents. You understand? Good, 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 good. Let's go. And then when you place a trade on a mini lot, so a nano lot will be 0.001, a micro lot will be 0.01, a mini lot will be 0.1, and then a standard lot will be 1. Do you understand? As easy as that. So, and also let me mention this before we move on. The amount you are trading with, right? The type of lot size you can open or you can trade with is based on the leverage your broker allows you to use. Do you understand? So let's move on. Understanding pips. Pips, percentage in points. A pip is a unit of measurements to express the change in value between two currencies. The same way they say the unit of measurement to the unit of measurement for distance is kilometer. The unit of measurement for liquid is milliliter. I get confused between milliliter and millimeter. So let's just stick to one. So milliliter. You understand? The pip is a unit of measurement to express the change in value between two currencies. So should the currency move from 1.1538 to 1.1539, that is one pip. Let me put it over here. Okay, let me go back to this. Make the screen display. So now, good. So this is a pip. So let's say the oh, okay, the pen. So let's say the price is moving, okay, it's moving upwards. Okay, now let's say this is 1.2563. You understand? You understand? Je vais, oui. And then here is 1.2569. You understand? Oui. Yes, you understand. It's trying to tell you that from this point to this point, price has moved 6 pips. Do you understand? 6 pips. Price has moved 6 pips. It's the same way a car will be moving from here. Let's say this is a car. We'll move from here and then reach here. And we'll say the car has moved 80 kilometers. Do you understand? We are just measuring the distance in price, the change in the units of both currencies, USD and then GBP. Do you understand? So we are saying that let's go back to trading view. But homodena brand term, let me use a pair like it's good. Euro USD. It's in an uptrend now. Boom. I see. I saw. It's in an uptrend now. You see, So a move like this, let's go, let's go, let's go. We are trying to measure. So we are saying if price has moved from, understand, like this shit. If price has moved from here, this point, from this point all the way to this point, right? We are trying to measure how many pips is this. So let's assume they've not created the word pips. If you see this movement in price, how will you know, like, how will you be able to quantify it? You understand? You say, you can't see how many kilometers has price move because price is not on the road. Price is not on a distance. It's a data. You understand? You're tracking the data. So it's asking, this is the case, this is the issue. Price is moving. We don't know what to call the movement of it. So it has changed in price from here, this point, that is point A. Let me put this here to mark. Point A. And then it has reached here, point B. Point B. What is the measurement for this? So now let's measure. Okay, I'm just using a shortcut, but let me go. To measure, you go to your measurement tool. This is the measure tool. Understand? To use it, you click shift and then you just use your mouse. But let me go here and click here. So now that I've clicked it, it's activated. We do this all the way to this point. Good. Price has moved 99 pips. If you are using a standard lot on 99 pips, guess how much you'll be making? So 99 times 10, you'll be making $990 just by placing a trade that is giving you 99 pips. You'll be making $990. Do you understand how pip works now? So yes, lot size is there, lot size is powerful, but lot size cannot operate if you are not, you know, what word is there? I don't like this, bro. The lot size cannot operate or cannot give you any amount of money, right? If you are not placing a trade that is giving you a considerably good amount of pips. You understand? Good. Now let's quit this. I'm quitting them because I don't want to open too many applications on the this one and make it run slow. Good, good. You get it now. Good. That's pips. Let's go back to this. So Euro USD moves from 1.050 to 1.051. If you minus it, you see that it's left to just one. So that's one pip. There are some currency pairs that have 5 decimal points. So the last number, that's the fifth number, is called a pipette. That is 1/10 of a pip. Do you understand? Good. That's 0.0, that 0.0001 USD rise in value is one pip. Do you understand? So let's say the US dollar gains strength, but then we want to be able to measure. We say, you cannot just take the US dollar and know the value attached to it. Yes, the value attached to it is 200. Let's say it's a $100 note. You will know that, okay, this is a $100 note. This is the value it has. It has $100. But we are looking at the data of the market. Do you understand? The economy, the data, the back end. You know that this is moving in pips. Do you understand? So at the end of each trading day, we say that, oh, the US dollar moved this amount of pips. Share you, Bob. It is usually the last decimal place of a quote price. Most pairs go up to 4, but some go up to 2. Do you understand? And some 2 is 3. Like the USD JPY is just 2. Do you get it? So for that one, 1.123.00 to 123.01. That's a 1 pip movement. Do you get it now? Good. So the ones with 5 decimal points, the last number is a what? It's a pipette. The fourth number is a pip. The third number is tens of pips. The fourth number is hundreds of pips. The fifth number is thousands of pips. So if the Euro USD moves from 1.15382 to 2.15382, that is 10,000 pips. If you bag a 10,000 pips in the market with a good lot size, like a standard lot size, uh, if your parents advise you to be falling at the back of your ears, and as I'm just joking, if people advise you take, I'm not saying they disrespect anybody. Leverage. This is where I wanted to get to. Leverage. Leverage is a double-edged sword. Do you understand? Leverage is not to be played with. So brokers can give you a good leverage, right? They can give you a good leverage, but you may not be able to make anything out of the market. Why? Because leverage is a double-edged sword. Do you understand? You are using an account to access the market. What leverage really means is that trading, let me give you some history. Trading was cut short from the people they'll call normal people. Do you understand? Like trading was a classified information. It was for inside people. Do you understand? So if you want to trade on the market, on the Forex market, you have to have like $100,000 and above. But then for the normal person or the common person who wants to trade in the Forex market, right? And you have only $100, how do you participate in trading this market? How do you place a mini lot? How do you place a micro lot or a nano lot? Do you understand? You'll not be able to because you need $100,000 plus. This is where your broker comes in and then they do what? They give you leverage. Now, how leverage works is that leverage too works with margin. And then I'll dedicate a whole video for margin. Then I'll explain it and show you the calculations. Do you understand? Let's say your brokers give you a leverage of 1:100. Do you understand? If you have $100 in that account, in a 1:100 leverage account, that means in the market, you are able to control a position size of $10,000. That means you can open a mini lot, you can open a micro lot, you can open a nano lot. The lot size you cannot open is what? Standard lots, because standard lots represents $100,000. Do you understand? It represents $100,000. Then now people will ask, if you have $100 in your account, how can you possibly control a $10,000 position size? Is because your broker is giving you a loan. This is why I said I'll dedicate a whole session to explaining what margin is. It's like your broker is giving you a loan. Do you understand? And then they are telling you, see, you say you're a good trader, fine, no problem. But I'm going to give you a loan of 9,000, let me see, $9,100. Do you understand? No, $9,900. That means plus $100, it will become a $10,000 account. So you have $100 in the account, but your broker is what? Is supplying the rest for you. You understand? So if they supply the rest for you, they are watching your trade closely. They've built systems to watch your trade closely, such that if your $100 is about to be vaporized from the market because of your own inability to trade effectively, right? What they'll do is they'll close down that $100 account because they've loaned you some amount of money, but they are not going to allow that loan eat into their capital. The broker is not a fool. You understand? They want to help you trade and you become a trader, you make your money, but they are not going to support you all the way to the point where they will now be taking loss for you. You understand? So sometimes you can be in a trade, your account will be sinking and you get a margin call, your broker will call you. Hello, your position trades, sorry, your trades are sinking. Do something about it. Top up the trade or liquidate the trade. Do you understand? You are doing either one of them, and whichever one you choose to do is what's going to tell how your account is going to be handled. If you decide to top up the account, that means you have more capital, then the trade can continue running. That's if you believe the trade will go your way, and that too goes either ways. You understand? Good. The amount of leverage you will use is dependent on your broker and what you feel comfortable with. Typically, the broker would require a deposit margin. That's why I was saying that I'll explain margin later. So this $100 is like a margin. Do you understand? Your broker has this money in their possession. Do you get it? And they are saying that, okay, this is like a safe deposit. They are not going to take it. They're not going to spend it, but it's like a safe deposit with them, so that the place that you are the trades that you are placing, if they do not go your way, they'll use this $100 that is in a safe deposit with them. They'll use to clear the loss. Again, the broker is not in the game of taking losses for its clients. They don't do that. You understand? They don't do that for any client. They don't love you to that point. They are just in the game to make business. You understand? Thank you. So the margin is the minimum amount you must have in your account for you to be able to take a trade on leverage. Do you understand? So yes, the margin you have in your account is $100. Based on that $100, they are going to give you a leverage. You get it now. And then that leverage is what's going to lead to you making a lot of money, you being able to place a lot size of a nano lot, a mini lot, a micro lot, or a standard lot. You understand? Now, the last message here is a minimum of $10 is needed for Xness at the moment as your starting equity. So if you trade with a broker called Xness, a minimum of $10 is what is demanded. You understand? To start trading. Spread. This is one of the hardest things people have. This is one of the hardest things for people in the trading space to understand. Spread is like the cost. So forex brokers usually quote two prices for a currency pair: the bid price and then the ask price. And then I mentioned earlier, I mentioned in the previous session, the bid price is the price that they put over there if they want to buy something from you. That's if you are selling to the broker. And the ask price is the price they quote when they want to sell something to you. That's if you are buying from the broker. Do you understand? So now the ask price for Euro USD is 1.14920 in this screenshot, right? That's to tell you that you may go anywhere, the banks can give you a better price or whatever, but the price they want to charge you for Euro USD is 1.14920. You see, 1.14920. And then this is the bid price. Now, the difference, you can see that these two numbers, right, they are different. You see, and then trading is the simultaneous buying and selling. Do you understand? So now let's say I've done my analysis and then I'm going to buy Euro USD. So I'll press ask. Then when I press ask, that means this is the price I'm buying. I'm buying for, but this is the price they are. Wait, yes, uh-huh. This is the price they are selling to me. So if they are selling this price to me, right, someone else somewhere is buying. See, let me make this clear for you. Let me take some support. Okay, good. So the spread is the math gap or difference found by subtracting the bid price from the ask price. It acts as a hidden transaction cost for your trades. Do you understand? So between the bid and then the ask, if you minus these two, if you take this out of this, that means the spread for Euro USD is 8 pipettes. Do you understand? So now the bid is what? The price the buyer wants to buy an asset. Do you understand? The ask is the price the seller wants to accept to sell an asset. Okay, okay. So you see, if you enter the market and then you are asking, like let's say the broker is selling. If I use this example with brokers, you might not understand. So let me use it with uh, phone dealers. Do you understand? The phone dealer is, let's say I'm the buyer. I'm going to the phone dealer, right, to buy a phone. I mean, it's please, it's quite confusing for me right now. I know it, but it's quite confusing for me in this moment. You understand? So let me get something. Okay. Uh-huh. So what the broker will do is that he will bid. No, what I will do is that I'll bid. Good. Now I have it. What I will do is that I'll bid. I'll bid the price that the I want to buy the phone. Do you understand? So the broker is giving me a certain price. So I'll bid my price. Do you understand? You say, oh, the bid that I've given is too small. He doesn't want that price. Do you understand? The bid that I've given is too small. He doesn't want that price. So I'll continue bidding until I reach his desired point where he's willing to accept that amount of money. Do you understand? So I'll bid. And let's say I want to buy an iPhone, whatever, iPhone 13. Then he says, oh, it is 2K. You understand? So I'll bid 1.8, 1.9. Okay, then I'll read 2K. Do you understand? Now, that 2K that I've bid, right? The normal ask price, you see, the normal ask price may be 1.9K. But he has bid 2K. He has added some small. That's why they say it is the gap between the bid and then the ask. He has added some small price to it. That's the 100 cedis. So if I buy at 2K, the 100 cedis is what he is making. So the broker has given two prices over here. One is bigger, one is lesser. You understand? If you are putting in or if you are buying at a certain price, they are also selling at a certain price. That's like the standard price. You understand? But they've added their own commission to it. It's like it's an integrated thing now. You understand? That's the cost that they are going to take to facilitate your trade or to open your trade. Do you get it now? Good. The bid is the price at which you can sell the base currency, and the ask is the price at which you can buy the base currency. The difference between these two prices is known as the spread. So the difference between these two prices, just the same way the phone dealer adds that small 100 cedis to the price of the iPhone. Do you understand? The spread is what your broker charges for facilitating the transaction. It's just that these people, they are not selling phones, they are facilitating a transaction. So your market orders, the orders you are placing in are going to they are going through the broker into the market. Do you understand? But the brokers are the ones facilitating. They are telling you that I'm not going to facilitate your trade for free. So what I'm going to do is I'm going to incorporate my pricing into the bid and then the ask price. So anytime you click a buy or a sell, they've already taken their cost from your transaction. It is done by the broker selling the currency to you for more than they pay to buy it. You see, just the same tactic in business. When someone goes to the production company, they go and take the wholesale. They come and sell it to you at they come and sell it to you at an added price. They add some small something to it because they are not going to pay transportation, go to the market, find a good sweat, walk around, leg pinning them and things, and then will come and sell it to you for the same price or even cheaper. People are not in business for that. It's only nice guys that want to do things like that. You understand? Business, you have to be rigid. You can look at your friend's face and say, hey, stop over there. I'll sell it to you at the price that I want to sell it to you at. If you don't want to buy, go somewhere else. Do you understand? And also buy from you for less than they will receive when they sell it. You understand? So when you are asking, the bid and ask is quite confusing. The price at which you buy the base currency, the bid is the price at which you can sell the base currency. So let's say you want to sell the base currency. This is the price they are going to give you. Do you understand? This is the price they are going to give you, and this price is lesser than what they would sell it for, because now you've sold it to them, it's in their possession. If they are going to sell it, they are going to add some more money to it. Do you understand? Good. They are not in the business to make loss. They are not fools. Now let's come to forex orders. And for this particular slide, I wanted to create a demo account to teach you, but the demo account was not creating. So uh, hold on, I'm creating a demo account. Good. Now I have a demo account. I have a demo account. So what I'm going to do is that I'm going to share my whole screen. Yes. So forex orders, buying and selling. An order tells your broker how and when to execute your trade. You understand? So let's say I put a trade inside this. I'm going to look for BTC because BTC is the only market that is active. The crypto market is the only market that is active during weekends. My microphone is still active. Good. Let me see. BTC USD. Oh. BTC. Bitcoin. Oh, I'm spelling it wrong. These people don't have Bitcoin on their quotes. Hold on. It's like these people don't have Bitcoin on their quotes. Metals. Mm, Let me see if the index market is active. Okay, the index market is active. I'll intentionally place a trade. Oh, it's not active. 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 If it was active, I'd have seen a buy or sell button. It's not active. It's not active. Let me see the Nasdaq stocks EFT warrant. Let me see stocks. Stock market too will not be active. It's not active. So what I can sheesh. Okay, I just have to close it. But what I can do to help is that when the market is open, when I'm doing the margin, video, I'll put all this together and then I'll show you, right? But then an order tells your broker how and when to execute your trade. Do you understand? So market order. When you place a market order, that means you are watching the market with your eyes closely. You understand? You are watching the market, and then you decide you are going to buy. So immediately you press buy, then the market executes, your broker executes your order immediately at the current price that you are buying at the current price that you press buy at. Do you understand? Sometimes due to your network errors and all those things, it might not fill immediately. Do you understand? A limit order. What a limit order does is that, let's say the market is rising. Let me go back here. Let me share my whole screen. Now let's come here. Let me do this. Okay. So let's say the market is buying, right? And you know that the market goes from up to down, up to down, up to down, up to down, higher high, higher low, higher high, higher low. But your analysis tells you that the market is going to come all the way here. Hold on. Your analysis tells you that market is going to come all the way down here before it continues buying. So what you do is that you will set a buy trade like this. So you set you set a buy trade like this. Good. Your stop loss will be here. Your take profit will be here. Do you understand? So you set your order here at this particular line. That means that it's a limit order. Do you understand? You are limiting the market. You are telling your broker that you've limited them. When the price gets into this point, so it goes down, goes down, goes down, goes down, goes down. Immediately it gets to this point, you are telling your broker that they should what? They should activate that trade for you because you believe it's going to continue buying, and then it will hit your take profit over here. So TP. Do you understand? That's a limit order. Do you get it? Now, so that this is a buy limit order. So a sell limit order would have been the flip side. Let me do it. So the market is selling, selling, selling. But you believe it's going to come all the way here. You see, you believe it's going to come all the way to the top here before continuing the sells. So you place your limit order here. Market goes down, goes down, goes down, then it comes all the way up and then it drops again. Immediately it touches this point, your broker is going to what? Is going to activate that trade for you. So you don't have to be watching your phone. So maybe you are a trader, but you also work some side jobs. You are doing your work. You don't have time to watch your screen and all that. You use limit orders, and those are the kind of orders I like to use, especially on a live account, because when you are doing it on a prop firm account, it may get activated at the time where news is coming out, and some props don't allow news trading. So what they do is that they kick your account. Boom, you're gone, you're gone, you're gone. And then this is a buy stop. So let's say the market is going up, 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 up. But how the market is going, you believe is going to continue going up until here. So what you do is that you place your buy stop somewhere here. This buy stop states that, so for this kind of buy stop, it's like you have confidence in what the market is going to do, right? So you put your, oh, you put your buy limit over here, over this line, because you are confident that the market is just going to break through it and go. You put your buy limit over here, and then you put your take profit over here. So I'm going to adjust it, right? Because you believe the market is going to come all the way here. So what you do is you put your buy limit over here. If the market is moving, sometimes and when it passes this level, it has not hit your stop loss. Why? Because it has not activated the order already. So it may be moving, going down, going down, going down, but then it goes up massively, breaks this point. Immediately it touches this point, they activate your order, and then they send it. If it's going to go your way, boom, it goes all your way, hits your take profit, and then you're out of the market. The same way for sell stop. Sorry, not as this is buy stop, right? This is stop. STOP, a buy stop. For sell stop, this is how it works. So the sell limit is that the market is going down, but you believe it will go up before it continues the rundown. So you put your sell limit over here. It will come up, activate it, and then go down. You understand? It will come up, activate it, and then go down. So this is how buy stop works. Buy stop starts like this. Sorry, this sell stop. Sell stop starts like this. But let's say the market is currently ranging, but you believe it will reach all the way here. And then you have something to do. So you cannot monitor the price. What you do is that you put price, your line here, right? And you believe that if it breaks this point, it's going to continue selling all the way here. So you put your order in. Put your stop loss here, red, green, boom. You see, so as the market is moving, immediately it touches this place, it triggers, then boom, it goes all your way, and then it hits your take profit. You understand? Then a buy stop will be something like this. The market is going up. Then you believe, okay, I didn't do that with reasoning. You believe it's going to reach here, right? So what you do is that you will now place your you will now place your order here. It could be the tip of this, it could be just here, right? And then you place this order too. So immediately it triggers this place. No, oh sorry, let me go back to the drawing tool. Immediately it triggers this place, boom, it takes your order up, and then you are inside the market. You've made your profits. You understand it now? Good. Let's go back. So I've explained all these four. So the market order is immediately. The limit order executes only when price reaches your chosen better price. The stop order executes once price passes your set level. The stop loss order, it automatically closes your trade if it moves against you beyond the limit. You understand? So over here, right? This is where the stop loss order is, this point. That means that if the trade triggers and then it doesn't go all the way here, your broker should take you out when the trade goes all the way here. That means you are not willing to accept any loss past this level. That's the stop loss order. And then the take profit order is the one you set over here. That means if the trade triggers and then is going your way, immediately it gets to this point, they should take you out. Why? Because after this point, you don't believe market is going to continue buying, or market may continue buying, but you no longer want to participate. You're okay with the profit you've seen. You understand? So let's close this. Let's go back to the slides. Okay, let's go back to the slides. Demo trade your way to success. Just like any other endeavor, you need to practice first, and you need to practice a lot. Do you understand? You have to be practicing. You have to be practicing every day. So what I did is I created a demo account of $100. Sorry, $100,000. Do you understand? Create a demo account too. If you don't know how to, text me, I'll guide you, or put it in the group. Anyone who knows how to will guide you. Do you understand? And then you create a demo account. Do you get what I'm saying? You create a demo account. You use that money towards to test how the market is, place your orders, enter short, enter long, buy, sell, take profit, stop loss, do all those things until you are familiar with the market, until you understand the language of the market before you put a real money inside. So demo trading allows you to practice trading strategies, gets you familiar with the market without risking real cash. Just as the name says, demo, it's like a dummy account. So you're opening a dummy account, opening trades, doing everything you can do, but it's just that it's not real money. Do you understand? So if you perfect your strategy on a demo account, then you can put real money. And then when you put real money, you're just going to what? You're going to follow the same pattern you use for the demo account to raise it from that small amount to a big amount. How long should you demo trade? How long? Until you have built confidence enough to step into the live arena. You see, some people don't have that confidence to step into the live account. So what you can do is you can practice. And when you are practicing, what most people fail to do is that they see it as demo. They don't attach value to it. They don't see that it's not the money or the numbers that they are trading, it's their strategy. Your system is what brings you the profit. You get what I'm saying? Good. So if you stick to the system, then what are you going to do? You are going to make profit. It's as simple as that. Do you understand? So until you've built the confidence that, oh, your strategy works, you've seen it take a demo account from this level up until this level, then and only then would you make the decision. I'm not going to tell you that demo trade. I won't do that. No, never. I won't do that. I won't tell you enter a live account. What I'll tell you to do is to enter a demo account and trade. But to enter a live account, you won't find me telling you that thing. That's when you yourself you build the confidence to do or to enter a live account. Until you have consistent results from testing out your strategy. So sometimes if you have a demo account and you can reason, you understand, you are placing trades, you are using a strategy, you are seeing that this strategy is going well, is raising this demo account from $100 to let's say $5,000. From there, is now the time that you will make the decision and you sit down and say, ah, this thing has yielded profit for me, so I can take it into live accounts. Then you trade the same strategy. Forget about the emotions, because it's the emotions that stop you from making money. Do you understand? It's the emotions that stop you from making money. Good. It is important to stick to one pair or one instrument when you are trading demo. The reason is that every market has their market structure. They have the way they move, they have the way they respond to price, they have the way they, allow economic events to affect them. So if you are demo trading and then you are watching everything, gold, GBP, USD, euro, silver, copper, livestock, sugar, everything is going to confuse you. Why? Because you are now starting. You'll be seeing a market structure on gold, and then you've tested it out so much on Australian dollar. Australian dollar moves slowly, or sometimes the New Zealand dollar, they move slowly. So when you see it on gold, you'll be okay. No, let's say you've been testing on gold, right? Gold moves very fast. Been testing on gold, testing on gold, testing on gold, testing on gold. Now you go and test that same strategy with the Australian dollar. Immediately you enter a trade, you'll be expecting it to move fast. Do you understand? Now, if it's not moving fast, you get frustrated and you exit the trade. Most times, immediately after you've exited the trade, then the trade goes your direction. The reason is that every market has how they respond. So if gold moves fast, that may not be the same thing for Australian dollar. So you would have to pick a certain market and then test it out to the fullest capacity, your fullest capacity. Do you understand? Remember, demo trading does not perfectly replicate the emotional and psychological pressure of live trading. Yes, some people are emotionally attached to their demo trade account. You understand? And then I don't know whether to say that's good or that's bad, but you know, if you're emotionally attached to it, it makes you understand that, oh, this same thing can happen to your live account. So when you're trading, you have to trade logically, you have to trade based off of the system that you've created. But when you enter a live account, everything changes. The whole situation changes because you're in a live situation. If you make a wrong move, you lose money. If you make the right move, you gain money. You understand? Good. So that's how it is. Riches through trading. Play the long game. You understand? You cannot be running a marathon and then immediately they say start. And then immediately they say start. You would, like, you give your full energy. No, that's not how you run a marathon. A marathon, you start, you want to maintain a pace. You understand? That pace is what's going to carry you from the start to the finish. If you want to run 100 meters, then go in the competition for 100 meters. But if you want to run a marathon, go in the competition for a marathon. Do you understand? So you start, you maintain a pace. What I'm telling you is that when you start like this, maintain that pace, continuously learn, ask questions. The Discord server was created for you. It was created for you. So I don't understand why being the Discord server, you not be asking questions. You rather come and text me on WhatsApp. You understand? Sometimes when you ask a question in the Discord server, someone else can give you a better understanding. So when you ask questions in those servers, what you are doing is that you are throwing the question out to people who know. Do you understand? So that even if I reply you, someone may give you a better perspective that will make you in particular understand. But what I may tell you, you may not understand. Do you understand? Good. So that's how it is. Play the long game. Look for the long term. Look for the long term. Look for the long term. Don't be in the trading there. You want the money right now. Don't do that. You're going to destroy your account. You're going to destroy your emotions. You're going to destroy your psychological system, the psychological system you used to trade. You understand? The market is easily accessible to all individuals, even those in the smallest, with the smallest amount of capital. It offers, and then I mentioned earlier, You can even trade with $10, $20, $30. A small capital. So the market is accessible to everyone. It doesn't matter which part of the world you are. As long as you have $10, you can start trading. It offers the potential of high returns due to leverage and market volatility. I explained that earlier. If you have a good leverage and the market is very volatile, you can make a lot of profit. It is important to consider the following before you start out. All traders lose money. All traders lose money. Last week, I lost like 100 and something dollars on the market. I kept quiet. I didn't go and cry to anybody about it because it's an occurrence. It's as a result of my own decision that I took in the market. So I didn't go and cry. I didn't go and hold anybody's leg. Charlie, I lost money. Doesn't. We don't do that here. You can speak to another trader so that they help you recover emotionally. But it's not now that you're coming to hold their leg and say, Charlie, I've lost this money. They are not going to refund you your money unless the person wants to be nice to you. Do you understand? It's your own responsibility that caused you to lose the money. So you go and speak to another trader, looking at them thinking they'll give you money and say, go and trade again. Cafe bull. They don't do that thing over here. You understand? Unless you come with a plan, you come with a system, you speak to another trader, they say, okay, based off of the system that you say you are using, I want to give you this amount of money. Do you understand? Good. This is due to lack of planning or training. Sometimes some people don't plan and they don't train well enough to enter the market or participate in the market. So what happens is that they lose a lot of money. Indiscipline, greed, or not having a system to follow. Greed, fear. These are traders' two biggest enemies. Do you understand? Sometimes they've not planned, sometimes they've not trained, and most times because people have not trained in the market, they lose a lot of money. Do you understand? Indiscipline, greed, and not having a system to follow. To effectively trade forex, you must have some sort of income to quench the need to make home run trades. Home run trades are those trades that immediately you put in the market, you're expecting it to boom. You understand? And then you make a lot of money. It doesn't happen here. Sometimes, beginner's luck. Me, I never got beginner's luck. I was never lucky in the beginning. If I make one mistake, no. If I make one mistake, no. If I make one mistake, no. The market was merciless with me. It taught me on the hard end of it. Do you understand? That's why when I'm speaking to you, so I'll speak to you on the hard end of things. On the hard end of things. You understand? So to effectively trade the forex, you have to have some sort of income. You have to have something that is giving you. If you don't have anything that is giving you money, someone is sponsoring you. You are under the care of someone and you have food, you have everything. If you have that and then you are still placing trades to make home runs, then I'm sorry to say you are not in the right state of mind. Fix your psychology and come back. Do you understand? Because there's no way somebody is giving you food. And now you want to place big trades to go and now buy something like you are comfortable. Although I speak against comfortability, but now see you are comfortable in a space. You don't need money to feed yourself. Someone is feeding you. You don't need money to pay light bill. Someone is paying for you. You don't need money to pay water bill. Someone is paying for you. Focus and learn. Practice. Build your system. Trade. You will make it. Do you understand? But for people who take care of themselves, it's best if you have some sort of income. Some people are able to trade without any income. The money they trade with is the money they eat from, is the money they pay bills with. To be on the best side, right? Have some sort of income. While getting rich is possible, it is important to approach it with caution, realism, and a long-term mindset. Approach it with caution. Trading will make you rich. Boom. Easy. Do you understand? But approach it with the caution that it can also take everything you have from you. People have sold their lands, their mother's houses, their father's houses just to trade, and then trading took everything away from them. Now they are in huge loss. Be real. if you've not practiced enough, be real with yourself. You understand the things that are going on in your mind, in your heart. Be real with yourself. Let yourself know that you've not practiced enough. Do you understand? So what? So don't engage in the market on a live account. Simple. Or else you pay for it. I will not pay for your mistakes. I pay for my own mistakes, so I don't want to add another person's mistake to my own mistakes. You pay for your own mistakes. I pay for my own mistakes. You understand? Realism and then a long-term mindset. Be in for the long run. If you make $10 a day and that's your target, end it. Close the market. Close it. Because if you risk again, the market likes this so much, it will take it away from you. Simple. To take it away from you. Simple. Crass. Simple, simple, simple. Like this. Understand? So the long-term mindset. Set your objective. You make a day $10. Tomorrow you make $10. Next week $10, $10, $10. You are building. You are focusing on the long term. You understand? Rather than impulsive traders, they make money today. This so it's possible. Then they put in again bigger lot size, bigger lot size, bigger lot size, bigger lot size. The market is watching you. It's smiling. It's smiling. It's smiling. When the time comes, take it away from you. So thank you for tuning in, and you are welcome. If you have any questions, let me know before I end it. If you have any questions, let me know before I end it. And if you don't have, let me check the group. Okay. So that'll be all for today. Thank you for tuning in. I hope you learned something. I hope it will aid you, your journey in trading. Thank you very much. Bye.